Welcome to Private Asset Management's Week in Review. Today is Friday morning, September 23rd. I'm Dillon Hakes. I'm joined again by our Chief Investment Officer, David Allen. David, it's another very difficult week for markets. We've strung a few of these together. The big event we had this week, we heard from the FOMC, we heard from Jerome Powell. They decided to raise interest rates again. What are the broad strokes that we learned out of the meeting?
So as we expected, we did get 75 basis points of Fed funds target hikes. That takes the Fed funds target to between 3 and 3.25%. That's the highest that we've seen since January of 2008. So rates haven't been this high for quite a while. Also, as we expected, we had a certainly more hawkish set of economic projections from the committee than we saw in the last version that came out in June.
I know you posted a blog post on the website this week talking, more details of what we learned from, but give me the little more detailed strokes of what came out of the meeting and what we learned.
Right, so I really think we learned three things from the meeting about where the Fed is expecting to take policy. The first being that we're expecting another 125 basis points of rate increases before year end. That's probably more than the market was expecting before the meeting came out. And it does set us up for a 75 basis point increase at the next meeting in early November, and then perhaps a 50 basis point increase at the meeting in mid-December.
All right, that sets up the rest of this year. What do we learn about looking out farther?
That was really my second big takeaway from the meeting, which is that the Fed's economic projections have certainly moved closer to something that seems realistic amid this ongoing fight against inflation. They revised down their expectations for growth in the U.S. economy and revised higher what they expect to see in terms of the unemployment rate. That weakening of the labor market is certainly something we expect to see as the Fed continues to increase rates over the next couple of years.
What about after the meeting? We heard in the press conference from Fed Chair Jerome Powell, we saw markets move around significantly. They had rallied quite a bit, when the decision came out. Then this Fed chief spoke and markets dropped pretty significantly. What did we learn from Jerome Powell that spooked markets?
Well, I think one of the things that markets were reacting to was really my third big takeaway from the meeting, which was this moment at the end of the press conference where the Fed chairman was asked something about the projections and is this going to be enough to bring inflation back down to target? And he entertained that question and mentioned sort of reliance on incoming data. But then at the end, he sort of cleared the decks and said, but regardless of what our projections are today based on the data we have available, whatever actions we do take over the next year and a half, those will be enough to bring inflation back down to target. And he was pretty adamant in that point. And so I do think one of the things that we've seen in the market since that meeting is sort of any people who are still holding on to the hope of a Fed pivot or perhaps some easing of monetary policy versus the current expectation. I think a lot of those hopes have been cast aside at this point.
Turning back to markets, we talked a little bit about the sell-off we've obviously experienced this week. Where are markets sitting currently?
So right now, it looks like for the week, we're going to be down more than 4% on the S&P 500 for the second consecutive week. In terms of where we are versus where we've been over the last few months, we are, as we're recording right now, still holding above the mid-June lows, but it is very close. It'll be interesting to see if the market holds that level. The weakness this week has been pretty broad-based, across sectors. No sectors of the S&P 500 have posted a positive gain. So broad-based weakness, again, for the second consecutive week.
One interesting piece of data that we did see this week, we heard from a survey of market participants regarding investor sentiment. What did we learn about sentiment right now?
Well, the survey that you're referring to is from the American Association of Institutional Investors. These are retail investors out there in the market. And for just the fifth time in the last 35 years, 60% of respondents in this survey noted having a bearish sentiment about U.S. equity markets. This means that the retail investors who had been sort of the last holdouts in terms of optimism for U.S. equity markets have joined their institutional investor counterparts, and again, the majority of whom are now showing a bearish outlook for U.S. equity markets.
That may seem like a negative piece of news, but that actually could potentially be a bullish indicator. Why would that be potentially a positive for markets?
Well, it actually may end up being a good sign for U.S. equity markets because it may suggest that a lot of the the doubters of the Fed or those who are hopeful for a Fed pivot in its policy tightening may have been washed out at this point. It could suggest that we're closer to a market bottom. And historically, after we've reached these levels of bearishness among retail investors, we've seen fairly good performance in U.S. equities.
Turning to the other side of the equation, the other part of this sell-off has been connected to the rise in yields that we've seen over the last couple of weeks. I know we've been fielding a lot of questions from clients, people hearing about the fact that the 2-year Treasury has topped 4%. What are we learning out of the bond market? What are we seeing in yields?
Well, this is something we talked about last week also, which is that across the Treasury maturity spectrum, we've seen rates increase. And right now, fixed income investors have an opportunity to lock in some historically fairly attractive yields on their fixed income portfolios. As you mentioned, the 2-year yield is up over 4%. The 5-year yield is closing in on 4%. So again, there is some risk that rates may rise further, but I do think that those risks are asymmetric in favor of fixed income investors making additional investments right now.
The last piece of news that we heard this week, we heard from some of the central banks around the world that were also making some moves. Up to this point, it had been the Federal Reserve that seemed to be the first mover, potentially the most aggressive central bank trying to fight inflation. But that changed a bit this week. What did we learn?
You're right. This week we did see many of the other major economy central banks increase their interest rates also. The Swiss National Bank increased their policy rate beyond into positive territory for the first time in quite a while. The Bank of England increased their policy rate by 50 basis points. And so these moves by other central banks are likely to provide some stability for the US dollar.
Some stability in the dollar might actually be a good thing. I know that the FOMC is trying to strengthen the dollar, but obviously with such a disparity in policy, that can create its own set of problems. An interesting side effect of this and the strength in the dollar that we've seen all year and what central banks are doing across developed economies is how it affects emerging markets. What do we expect on that front? What are our concerns or potential fears going forward?
Well, as the Fed has been hiking interest rates, we have seen a strong appreciation in the US dollar. And that presents a risk to certain emerging markets, particularly those that have large balances of US dollar denominated debt. As the dollar appreciates, the cost of servicing that debt increases for emerging markets. And so, though we're perhaps expecting some stability in the US dollar, we're not expecting a big weakening. And so as these emerging markets continue to have to contend with this stronger dollar, it does likely will yield to some stress in certain markets and perhaps a busy period of time for the IMF.
All right, David, what do we have on the agenda for next week?
Well, there are a couple of reports I would highlight. The first is on Tuesday, which is durable goods. That's one of our better indicators of business investment. It's been a real question. In the last industrial production report, we did get some indication that perhaps business investment was holding up fairly well. It'll be interesting to see if that carries over into that durable goods report. But then really the big focus will be at the end of the week on personal income and spending for the month of August. Check in with consumers and their spending. That gives us a better indication of overall spending on goods and services than what we get on the retail sales report. It also gives us a look at PCE inflation, which is what the Fed focuses mostly on versus CPI. So PCE inflation and seeing how consumers are trending here in the third quarter.
I do think that PCE report is going to be something that's very closely watched. I think that'll help give us a little bit more insight into where Fed policy is going to look over the next few months. I want to thank everybody for joining Private Asset Management's Week in Review. I say it every week, but if you like and enjoy our video series, find it worthwhile, please go ahead and like and subscribe our video on YouTube. We will see everybody next week.